Well, this week had a lot of promise as far as being able to help the bond market and help interest rates. So we got a lot of economic data to digest. A lot of it had an opportunity to give us really probably the most significant change in rates that we have been hoping for quite a while. But we didn't ultimately get it, y'all. Spoiler alert. And I'm going to go through what happened this week and why we didn't necessarily get what we had hoped for, especially after Wednesday's numbers. Today is the 2nd of May, Friday. I hope everyone is doing well. We're going to dive right into the numbers and try and get through some of the details. Wednesday, personal consumption expenditures. The favorite read on inflation for the Fed is the one they pay the most attention to. Specifically, they look at the core rate of inflation. It was at 2.6. That's what was expected. So we got a flat report there on the core reading. The headline reading came in at 2.3%. Again, that's what was expected. That's what was predicted. And so it's a flat report. And flat was good news. No surprises on PCE to the upside was good news, or should have been good news, for the bond market. Keep in mind, though, that when that report comes out, especially in a week where we've got BLS report, labor report on Friday, the market's going to wait and see, because the Fed is looking for, or the markets rather, are looking for any occasion where the Fed might view a recession on the horizon. Labor is generally the first place you go to see that. So it's the canary in the mine as far as a lot of folks are concerned with predicting a recession. So a weak labor report in combination with a flat PCE report, and then we got a weak gross domestic product report on Wednesday, y'all. So we were really setting up BLS report today to be a huge market mover. Gross domestic product came down as a retraction. First time in 3 years, y'all, since we have seen a quarterly GDP come in as a contracted numbers, down 0.3% in the first quarter. Folks pulling back spending, going into the turmoil caused by tariffs, most likely. So we were set up nicely for a nice pop in the bond market if we had gotten a weaker than expected BLS report. However, we didn't. We got 177,000 new jobs created this morning. 130,000 was expected, much stronger than expected. There was a little bit of pain in the details, however, when you look into this report. The prior 2 months reports were revised downward, 58,000 jobs. Y'all, that is a huge revision. The BLS still does not have a good handle on this number. The markets discount this report, frankly, more and more when you have these massive prior month revisions, and we will get another one on this report. So the market was banking on 130, it got 177. My money is on the fact we'll see a lot of those 47,000 that were missed pulled out of future reporting as this report gets revised down the road. Doesn't matter. By that point, damage done. Any bid that we had in the bond market going into today's report was immediately priced back out. We've had the biggest one-day sell-off in interest rates in the bond market, rather, going back 30 days or so. Going into today, y'all, we had seen a 7-day stretch of interest rates improving a little bit each day. 7 consecutive trading days of improving rates until we got to this report, and then all red on the screen. So we have a little bit farther to fall before rates find their footing. And keep in mind that when prices fall in the bond market, yields move inverse to that price. Those yields are our rates. So we are seeing rates higher. How much higher? Mortgage News Daily today, 6.90 on a 30-year fixed rate conforming loan. 6.84 is where that survey was 1 week ago. 6.75 is where it was 30 days ago. So we're up about 1/8 of a point in the last 30 days. In fact, if you look for the past 4 weeks at where interest rates have been, we've been as high as 7.07 and as low as 6.81 in that same Mortgage News Daily survey. Now, let me hasten to add, y'all, I add this correction at least once a month in doing these videos. These are not our interest rates. These are not the rates that I'm quoting. The rates that I quote are typically significantly better than this, in part because of the region of the country in which I operate. Texas has very favorable markets here. We have some very secure, from a risk profile standpoint, MSAs in this state, particularly with our home equity provisions of the state being very restrictive. It makes lending in the state of Texas a little more profitable for lenders, and they're national companies, y'all, so they give a little bit of preferential pricing to local markets. And of course, I'm quoting national averages. So I want to be very clear that if you want to see what interest rates are doing, that's not what this is. This is not a quote. You need to call me and let me run through the scenario with you and give you today's best pricing. So That caveat aside, what does that mean as far as the Fed Watch tool is concerned? Well, the CME Fed Watch tool has priced out a little bit of the expectation, y'all. We had, I think, about a 10% likelihood of a rate cut going into the May meeting. So it wasn't likely to happen. That's now pretty much zero. 99.5%, no change, is being priced by the Fed futures markets for the May 7th meeting. June 18th, we're down to a 37% chance of a cut. At that meeting, it was much higher than that, y'all, just 2 weeks ago. And then if you look at the July 30th meeting, we now have an 80% chance of a quarter or more movement at that meeting. So everything changes on a dime, y'all. Every bit of data is moving the market in a big way. It's going to be interesting to see where these diverging numbers finally find their home. It doesn't make much sense that we would have a contraction in GDP and then have a beat on the jobs numbers. You can't. So we've got a conflict somewhere. If the economy is contracting, the jobs will show it, as they have been trending in that direction until we got to this report. In any event, we're going to continue to watch it. As always, y'all, we dive into these numbers carefully for one reason and one reason alone. It is to educate your borrowers about the best time to lock in their rate. Because as you have seen, rates vary a quarter of a point on any given day. And in any given 2-week, 3-week, 4-week period, they might move significantly more than that. So timing that lock-in is of paramount importance. We're talking tens of thousands of dollars for that client to make sure they got the best pricing possible. Just a reminder, it is against federal law for a loan officer to make more money based on the rate you are charged. So we are 100% focused on getting you the best deal we can, finding the best provider for it, and finding the best time to lock it. And it takes some detailed diving into the details like I do weekly to make that happen. Hopefully your clients will benefit from that. I'm always honored to have your referrals. You got all my contact info on the screen. Stay blessed, stay safe. We'll talk to you next week.